Hello viewers, today we will discuss the topic profit planning. What is profit planning? Profit planning can be defined as a set of steps that are taken by any business to achieve the desired level of profit. Planning is accomplished through the preparation of several budgets, which when brought through from an integrated business plan known as master budget. Objectives of our topic are to learn the methods of pricing, to learn about the advantages and disadvantages of different methods, to learn about the factors affecting pricing, to learn to make pricing decisions. Pricing is the process of determination of charging the customer for food items and services. In commercial catering, profit margins expected are greater than social institutions. Pricing takes on a cost-effective rather than a profit-making goal. There is a definite relationship between the price level and the volume of sales. The most important determinant of profitability is the volume of sales. Thus, the pricing policy is the most critical factor in the assessment of the viability of an establishment. Further, technological changes have altered the existing cost structures by shifting the emphasis from one type of cost to another. For instance, where certain jobs are totally or partially mechanized, the labor costs incurred previously have shifted to capital costs. Methods of pricing. The two methods commonly used are cost plus method, rate of return method. Cost plus method. Cost plus pricing is a cost-based method for setting the prices of goods and services. It involves the calculation of the food cost per unit of sales and then to cover the cost of labor and overhead expenses while also leaving a margin of net profit. A given percentage of gross profit is added to the value to arrive at the selling price per unit. Food operations generally add 150 to the cost of food to estimate the appropriate selling price. This is based on the estimate that food costs of the operations would be 40% and the gross profit 60% of the sales. For example, if the ingredients or food cost of a dish is 50 rupees, its selling price would be calculated as 50 plus 50 into 150 divided by 100 is equal to rupees 125, or simply 2.5 times the food cost or selling price is equal to food cost plus net profit gross. Advantages. The cost plus method is easy to apply and understand and is therefore widely used. This method is justifiable as in some cases where the supplier must persuade its customers of the need for a price increase. The supplier can point to an increase in its cost as the reason for the price increase. Disadvantages. Cost plus pricing is based on cost and does not consider the demand for the product or services. Net profit becomes the direct function of sales turnover, which can thereby vary and deviate from estimated figures appreciably. The gross profit margin is added to the food cost and the net profit is unrelated to the capital invested. Rate of return. This method is based on the relationship of net profit to capital investment. By this method, the likelihood of reaching net profit targets is greater if the estimated sales volume is achieved and the gross profit margins are maintained. The rate of return method of pricing, however, also has some disadvantages. The process becomes easy if there is little competition as compared to a situation where there is competition. The rate of return method of pricing, however, also has some disadvantages. It is purely profit oriented and has little scope for flexibility. Its approach to pricing problem is too simple to be realistic. It does not generally go by the demands of the customer or the market. This method, therefore, is not often used in everyday food pricing by food services. Large hotels which need to decide which 1 or 2 or 3 projects should be started, the rate of return method may be used for the selection, but that too along with other factors like short-term profits, lag period between completion of the projects and profit generation, the interest on investment if on loan, and so on. Some other methods used in pricing. Factor pricing. In this method, a simple factor is calculated based on estimated food cost percentage on which establishment wishes to work. This factor is called markup factor, MUF, which is then applied to the cost per unit to determine the selling price of food. For example, an establishment whose catering policy is to work on a 40% food cost basis will calculate its MUF. The factor method is a simple to apply as the cost plus method but has some disadvantages. Subsidy pricing. For establishments like employee canteens, schools, lunchrooms, university hostels and social institutions, the price of meals are subsidized by the management to various extents. Some establishments provide free meals to their employees and thereby subsidize their meals 100%. In other cases, employees pay just the cost of the food while the management cover the other cost of production. The prices to be charged are determined by estimating ratio, which can be applied to all items of sale. Example, an office canteen prepares and serves 250 meals a day for 300 days a year. The food cost of the meal is estimated at Rs 2 per head and labor overhead expenses at 5,000 and 2,500 per year respectively. What will be the selling price of the meal and the subsidy paid by the management? Number of meals served in a year, 250 into 300 is equal to 75,000. Food cost per year, 75,000 into 2, that is 1,50,000. Labor cost per year is 25,000. Overhead expenses per year, 13,000. Total sales will need to be 1,88,000. Average selling price 1,88,000 divided by 75,000 is equal to 2.50. Food cost per unit Rs 2 is equal to 200 paise. Therefore, subsidy 2.50 minus 2 is equal to 50 paise. In other words, while no net profit is made for social reasons, the management would subsidize the meals to 25% of the food cost. Price differentiation. It is evident that irrespective of the size and nature of the food service, establishment price fixation must aim at covering all costs involved in the preparation and service of food. The price charged to the customer does not always reflect quality or the quantity of the food that can be expected on a plate. This is because pricing varies with fixed cost and overhead expenses of every establishment. For example, price differences for the same item in different establishment. Food item can be dosa. Different establishments have different pricing. In a dhaba, it would be 12 rupees. In a coffee shop, 15 rupees. In a restaurant, 20 rupees. And in a college canteen, 10 rupees. From the above example, one can assume that a plate of the items served will be the best in the restaurant in taste, flavor, or portion size. The price differences are obviously due to lack of sophistication offered in service and equipment used. Discount pricing. It means charging the customer less than the declared rates on product menus or services. This is usually practiced to enhance sales during festivals and other celebrations by offering specials for the day, group discounts, or buffets. Discounts are offered for many reasons. Seasonal clearance of stocks could be one, attracting customers could be another, promoting a novel or creative idea could be one, or closing. Factors affecting pricing: food service establishment, location, size and type, menu, service style, pricing, external environment, poor harvest epidemics, transport strikes, riots, curfews, market closure, government policy. Pricing would reflect profile, purchasing power, likes and dislikes, expectations. These are based on special features of a food service institution, the type of customers it attracts, and the nature of the external environment in which it operates. Food service establishment: it comprises of factors like its location, size and type of organization, name offered, and the location. The location of the food service establishment largely affects the prices charged to the customer. It is common experience to find that a coffee shop situated in the marketplace prices its products slightly lower than the one in a posh residential area. This is because the former will have larger sales volume than the latter, where only occasionally the residents may choose to have coffee outside their homes. The latter charges more because of its higher fixed cost structure, which then must be recovered from the occasional customer. Size and type of establishment: the size and type of establishment has market effect on the price structure of its menu and other services offered. For example, a plate of sandwiches or pakoras sold by a roadside cafe or dhaba may be priced at ₹5, whereas in a restaurant the customer may pay double the price for the same product and portion to increased fixed costs of larger and better decorated and maintained premises. The menu: the composition of the menu determines pricing because of its direct relationship between food cost and selling prices. When sales are slack, cheaper substitute ingredients for dishes reduce food cost without altering the prices usually charged. This helps to increase the profit margin and offset the impact of lower sales volume. Similarly, changes in consistency or texture can affect portions served and consequently the prices charged. The type of menu plan also affects pricing. The larger the variety and flexibility offered on a menu, the greater will be the range of prices charged. Service style: pricing is greatly affected by the style of service offered by an establishment. If a self-service system is followed, the prices fixed could not be required to cover service charges to the extent that they would in a restaurant that offers waiter services. A lower price structure is possible in a self-service or counter service facility because the sales volume is greater because of higher customer turnover. A traditional waiter service puts up the prices because of the higher staff costs necessary, more space needed to serve and seat the customer, greater amounts of cutlery, crockery and other table appointments required, and so on. Customer: factors to consider with respect to the customer are his general profile, purchasing power, likes and dislikes, and expectations. Customer profile: the socio-economic status of customers largely determines what type of establishment they choose when they eat out. This is also influenced by the company they keep and entertain, the mood, the occasion, so on and so forth. Goodwill once established with customers, the organization stands to gain at any fixed price by the competition. Purchasing power: prices are affected by how much a customer is willing to pay for a certain type of food item or meal related to affordability. For example, a customer may be prepared to pay ₹10 for a burger, but would easily pay 15 for an ice cream. In fact, people decide in advance the general price category of the establishment they wish to go to. Some may therefore fix their price too low to attract more customers. Customers are not concerned about price once they have decided to eat at a desired establishment. Likes and dislike of customers. People go out to eat for a change from routine meal patterns, what they cannot get at home or in a hostel or other institutions, or for other psychological or social reasons. Customer favorites can affect the pricing depending on the demand created. Some hot favorites with children are burgers, pizzas, ice creams, chips, chaats, and so on. Whereas adults normally prefer a full meal of curry, naan, salad, and a sweet. It is important for customers to study their sales record and menus to list out customers' choices and cash on their likes while avoiding dishes on menus which are not ordered. Customer expectations. People eat out for various reasons such as hunger, social get-togethers, serious discussions, loneliness, etc., and expectations can vary considerably from one person to another in the same food service. The same person may have different moods and expectations at different times to which food services should be able to adopt constantly. Environmental factors. Factors like food costs, labor costs, overhead expenses, or sales volume affect pricing. Some such factors are poor harvests leading to less production and high prices of fresh fruits and vegetables, cereals and pulses, legumes, etc. Sometimes diseases in animals can lead to shortage and the food can become expensive to buy. A transport strike may inhibit transportation of food from growing to manufacturing areas. Riots leading to curfew situations, closure of markets, inflationary conditions created by government policy, changes in weather conditions which keep people indoors, and shortage of fuel are the factors which affect the customer's sales volume in food service establishment. Rich's quotas method of profitability. Net profit. Units of sale, variable labor, prices, food cost, fixed labor, overheads. He introduces very effectively the concept of profit sensitivity analysis (PSA) and the use of profit multipliers in making pricing decisions. As Richard Cotter says, the aim of PSA is to establish how various key factors like price level, food and beverage costs, labor costs, etc. influence profitability of the business. For example, the result of a catering establishment at the end of the month are number of covers sold 5,000, average price 5 rupees, sales 5,000 into 5 is equal to 25,000, food costs 10,000, labor costs 7,500, overheads 5,000, total cost 10,000 plus 7,500 plus 5,000 is equal to 22,500. Net profit would be 25,000 minus 22,500 is equal to 2,500. Obviously, the key factors that influence net profit values are food cost, labor cost, and the overheads. To establish quantitatively the extent to which each factor affects net profit, Cotas has suggested the following method. That is, assume a change of 10% in any one factor while holding all other constant and calculate the percentage change in the net profit and vice versa. For example, factor changed is equal to price level. If the price level is increased by 10%, that is from 5 rupees to 550 cover, what is the effect on net profit? Number of covers sold 5,000, price per cover 550, sales 5,000 into 550 is equal to 27,500, total cost 22,500, net profit 22,500 minus 22,500 is equal to 5,000. A 10% change in price has thus resulted in a 100% increase in net profit. Profit multiplier is equal to percentage change in net profit divided by percentage change in price. 100 divided by 10 is equal to 10. This means that for every 1% increase in price, there will be 10% increase in net profit and vice versa. Factor change is equal to food cost. If the food cost is increased by 10%, the effect on the net profit will be as follows. Total sales 25,000, food cost 10% increase 11,000, labor cost 7,500, overheads 5,000, total cost 23,500, net profit 25,000 minus 23,500 is equal to 1,500. This shows that a 10% increase in food cost lowers the net profit by 1,000 from 2,500. The percentage decrease in net profit is 40%. Therefore, the profit is multiplied is 4%. This means for every 1% increase in food cost, there will be a decrease of 4% in the net profit and vice versa. Factor change is equal to number of covers. If there is an increase of 10% in the number of covers from 5,500, the effect on profit will be number of covers sold 5,500, average price per cover rupees 5.50, sales 27,500, food costs increased 10% as increased in the number of covers, that would be 11,000. Labor cost increased by rupees 250, that would be 7,750. Overheads would be rupees 5,000. Total cost would be 23,750. Net profit would be 3,750. This shows that a 10% increase in number of covers increased the net profit by rupees 1,250 from 2,500. The percentage increase in net profit is 50%. Therefore, the profit multiplier is 5.0. This means for every 1% increase in number of covers, there will be an increase of 5% in the net profit and vice versa. Factor change is equal to labor cost. Sales 25,000, labor cost 10% increase, that would be rupees 8,250, total cost 23,250, net profit 1,750. This showed that a 10% increase in labor cost decreased the net profit by rupees 750 from 2,500. The percentage decrease in net profit is 30%. Therefore, the profit multiplier is 3.0. This means for every 1% increase in labor cost, there will be a decrease of 3% in the net profit and vice versa. Factor change is equal to overhead. Sales 25,000, overheads 5,500, 10% increase, that is. Total cost 23,000, net profit 2,000. This shows that a 10% increase in overheads decreased in the net profit by rupees 500 from 2,500. The percentage decrease in net profit is 20%. Therefore, the profit multiplier is 2.0. This means for every 1% increase in overheads, there will be an increase of 2% in the net profit and vice versa. It will be seen that prices and number of customers, both factors which have a direct influence on the sales, have high multipliers and appreciably affect profitability. The other factors, while exerting their influence, do so to a smaller extent. All these observations only prove what has been discussed earlier under factors affecting pricing of food, namely the importance of sales volume and mix, spending power of the customer, and gross profit margins. Making pricing decisions. Pricing decisions are generally made at higher levels of management, from where the establishment can be viewed in its total perspective with an understanding of the impact of different pricing policies on profitability. Pricing decisions are affected by the elasticity of demand, the cost structure of the enterprise, and its pricing policy. All pricing decisions made should achieve the goal of profit maximization. The more elastic the demand, the greater is the scope for an imaginative pricing policy. Special discount, off-season rates, or prices for specials on the menu can be offered on special occasions. These are primarily designed to optimize profits through increasing the volume of sales, capturing the mood of the customers during festive seasons. Imaginative pricing, however, is only useful over short periods. The price tactics resorted to are not often good enough to cover variable costs. This is also referred to as contributing pricing. Price discretion requires skill, initiative, creativity, and an accurate judgment of the customer's mood and receptivity to new ideas. When the fixed costs of an establishment are high, profit stability decreases because prices charged must follow market forces. Pricing has also been a challenge to the caterer because he deals with large quantities of perishable commodities. Today, catering has become more and more professional, and the variety of services demanded by the customer ever increasing. An intuitive approach to pricing is not enough. Accurate forecasting and tight controls through constant monitoring is required. It is vital to bear in mind that all calculations of costs, menu prices, profit margins need to be reviewed from time to time. A manager must keep in mind that he is not only selling food but a package of service, charm, warmth, atmosphere, cleanliness, location, and music, all of which affect pricing decisions. It also becomes clear that management must be devoted to the revenue controlling aspects of the business as well as to its cost aspects in proportion to their respective effects on profitability. Without this, the ability to predict the effects of pricing decisions prior to the implementation, a caterer cannot ensure success for this food service.